There is a number that determines whether buying a home makes you richer or quietly drains you. Most people never calculate it. They just feel like owning is better than renting, because that's what they were told. Today we're going to do the math, and the answer might surprise you. Here's what almost everyone gets wrong about the rent versus buy debate. They compare the mortgage payment to the rent payment. That's it. That's the whole analysis, and it's wrong. Because a mortgage payment is not the cost of owning a home. It's just the most visible part of it. The real question, the one worth asking, Sritis, is, how much money am I handing over permanently every single month that I will never see again? When you ask it that way, the math changes completely. A Canadian portfolio manager named Ben Felix put out a video a few years ago with one of the most elegant frameworks I've seen for this. He called it the 5% rule. I'm building on his foundation today because mortgage rates have shifted dramatically since then, and the numbers need updating. But the structure is the same. There are 3 costs of home ownership that you need to account for. Every single one of them is money you will never get back. 1. Property taxes. 2. Maintenance costs. 3. The cost of capital. Let's go through each one. Property taxes in the United States average 1.11% of the home's value per year. On a $500,000 home, that's $5,550 per year. Gone. It doesn't matter if the market is up. It doesn't matter if you're using the home or not. That check goes to the government every year for as long as you own the property. Next, maintenance. Experts recommend setting aside 1% of your home's value per year for repairs and upkeep. On our $500,000 example, that's $5,000 annually. And that's conservative. Older homes can run 1.5 to 2%. The leaking roof, the HVAC that dies in July, the foundation crack you ignore until you can't. These costs are real, recurring, and invisible in most people's rent fees by math. So far, between taxes and maintenance, we're already at 2.11% of the home's value per year, permanently gone. But the biggest cost? We haven't touched it yet. This is where most people's thinking breaks down. Economists call it the cost of capital. There are 2 parts to it. Part 1, opportunity cost of your down payment. Let's say you put $100,000 down on a home. That $100,000 is now locked up in real estate. It's not in the stock market. It's not compounding. Over the last 30 years, the S&P 500 has returned roughly 7.2% per year, adjusted for inflation. Residential real estate has appreciated about 2% per year after inflation. That's a 5% gap. Every single year. So that $100,000 down payment, it's costing you 5% annually in foregone returns. $5,000 per year, in exchange for sitting in a home that appreciates slower than the market. Part 2, the cost of debt, interest. Assuming you finance $400,000 at today's rates, call it 7%, that's roughly $28,000 in interest payments in year 1 alone. All gone. None of that builds equity. Together, those 2 numbers, $5,000 in opportunity cost plus $28,000 in interest, total $33,000 per year. That's 6.6% of the home's value, permanently extracted. Add it all together. Property taxes, 1.11%. Maintenance, 1%. Cost of capital, 6.6%. Total, 8.71% of the home's value per year. That's the annual cost of ownership. Not the mortgage, the real number. Now here's the rule. Home price times 8.71% divided by 12 equals the monthly cost of ownership. On a $500,000 home, that's $3,629 per month. That's what you need to compare against rent, not the mortgage payment. So if a comparable home in your city rents for $2,400 per month, renting wins, clearly, by nearly $1,200 a month. If rent runs $3,800 per month for a comparable home, buying starts to make sense. This is the break-even. Once you know it, the decision gets a lot cleaner. Now, I'd be doing you a disservice if I stopped there, because the math alone doesn't tell the full story. And pretending it does is just as misleading as the people who say renting is throwing money away. Let's talk about where the framework has real limitations. Advantage 1, forced savings. A mortgage payment is partly interest, yes, but it's also partly principal. You're building equity whether you feel it or not. For most Americans who aren't disciplined investors, this is the only wealth they accumulate. That matters. Advantage 2, leverage. When you put $100,000 down on a $500,000 home and that home appreciates 10%, you didn't make 10%. You made $50,000 on a $100,000 investment. That's a 50% return on your cash. Real estate is one of the few places where everyday people can legally use the bank's money to compound their own wealth. Advantage 3, inflation works for you. Your mortgage payment is fixed. But over 30 years, the dollars you're paying it in become worth less. That $2,800 monthly payment in 2025 will feel like a bargain in 2045. Renters, their landlord reprices every lease renewal. That's not a small thing. Advantage 4, capital appreciation. Median home prices up 2% per year sounds modest, but that's the median. Certain markets, certain neighborhoods have produced generational wealth. The $599,000 home that sold for $3.2 million 29 years later, that happened. That happens. Now let's talk about renting's underrated advantages. Advantage 1, mobility. If your career takes you somewhere better or your life changes, you leave. No transaction costs, no 6% realtor fees, no months of your life coordinating a sale. For anyone under 35 in a high-opportunity career, this flexibility is worth real money. Advantage 2, simplicity. No property tax bills, no emergency repair fund, no contractor negotiation at 8 p.m. on a Thursday because the water heater failed. Renters have one number, monthly rent. That's it. Advantage 3, liquidity. When renters invest the difference, the gap between what they would have spent on ownership versus what they're paying in rent, and they actually put it into index funds, the math can shift dramatically in their favor over long-time horizons. That's the key phrase, if they invest it. Here's the uncomfortable truth the math can't capture. The renter who pockets the difference and deploys it wisely can absolutely outperform the homeowner over 30 years. But that requires discipline, consistency, the ability to not touch it when markets crash or when a new car starts looking attractive. The homeowner is forced to build equity whether they're disciplined or not. The amortization schedule doesn't care about your willpower. Most people are not as rational about money as they think they are. That's not an insult, it's just documented human behavior. So which version of yourself are you planning for? Here's where the decision actually clarifies. If you're staying less than 5 years, rent. The transaction costs of buying and selling, realtor fees, closing costs, transfer taxes typically run 8 to 10% of the home's value combined. If the home doesn't appreciate enough to absorb that, you've lost money. Every time. If you're staying 7 to 10 plus years, buying becomes more defensible. Long-time horizons absorb the upfront costs, benefit from appreciation compounding, and let you build significant equity that you actually keep. The math on buying in today's rate environment is brutal in the short run. In the long run, especially with inflation as a tailwind, it can still work. One more thing I'd be dishonest not to address. Mortgage rates sitting at 6.5 to 7.5% change this equation significantly compared to the 3% era. At 3%, the cost of capital was modest. Buying was almost always competitive with renting in most markets. At 7%, interest costs alone on a $400,000 loan approach $28,000 in year one. That's $2,333 per month before you've paid a single cent toward principal, taxes, or maintenance. In today's rate environment, renting is more financially efficient in most markets than it has been in over 20 years. That doesn't mean buying is wrong. It means the bar is higher. Here's how to actually think about this for your own life. Step 1, calculate your break-even. Take the home you're considering. Multiply by 8.71%, divide by 12. That's your monthly cost of ownership. Step 2, compare it to a comparable rental in the same market. Step 3, factor in your timeline. Under 5 years, lean rent. Over 7 years, buying deserves serious consideration. Step 4, be honest about your investing behavior. If renting, will you actually deploy the savings into the market, or will they evaporate? Step 5, consider what you're buying. A home in a growing market in a desirable neighborhood has fundamentally different return potential than a median statistic. There's no universal answer here. Anyone who gives you one is either selling something or oversimplifying. What I can tell you is this: the worst financial decision is the one made purely on emotion, buying because it feels like the right time, renting because moving sounds easier. Both of those are expensive mistakes. Run the numbers. Know your break-even. Make the decision with clear eyes. Use it. And if you found this useful, subscribe. I cover personal finance the way it should be covered. No hype, no shortcuts, just the math and what it means for your life. See you in the next one.